Whenever you start trading in your personal capacity, whether it's you see it as formal or not formal, there is a tax implication for you. The matter is there's money going into your bank account potentially in your personal capacity, and you are trading in your own name, which is called the sole proprietor. Obviously, the motivation becomes difficult as well. And year 1 and 2 is easy because I'm busy expanding my business. I'm busy building it. There is a lot of expenses and not so much turnover yet, but I can clearly show my turnover is increasing every year, and potentially my advertising, all those expenses with that. In essence, mean is we put a fence around that specific trade of yours. So we keep that loss. You don't lose that loss. We carry over that loss every year, and the moment you actually start making a profit from that specific trade that we ring fence, you get all these losses and you can deduct it against the profit as soon as you make a profit. Every person in South Africa, doesn't matter if they work for somebody or already own a business, they all tend to look for another side kind of activity, side business, even if it's part-time, that they can potentially earn more income from. But this is typical kind of items that especially employees get involved with. It would be potential network marketing. I've got a number of clients that do network marketing that do it on a part-time basis because it's a cheaper option as well to kind of start a business. The most common one would be potentially property. So they rent out property as a residual income. Then the latest kind of thing would be crypto, where people also kind of can do it on the sideline, and it's not something that they need to involved with on a day-to-day basis and need to employ people to do that, because then it becomes difficult when you have a sideline business that also requires you to kind of manage people as well. Then it becomes a problem. I say this loss I'm talking about specifically section 20A. Specifically, it's applicable to individuals. So it's not applicable to companies, applicable as a sole proprietor. So you start doing something, doesn't matter, like you mentioned, something in the evening that you do graphic designing for people or whatever the case may be. It needs to be in your personal capacity. And whenever you start trading in your personal capacity, whether it's you see it as formal or not formal, there is a tax implication for you. Whether it's a net profit or net loss, you need to declare to SARS. Whenever you start trading in something, doesn't matter if you in your head you didn't register something. If you're not registered in a company, you're operating as a sole proprietor in your own name, and your registration number is your ID. People with that kind of just do their side business that they start. They always think that, well, my business is not registered. The fact of the matter is there's money going into your bank account potentially in your personal capacity, and you are trading in your own name, which is called the sole proprietor. There's no minimum as additional business as a sole proprietor. The moment you start earning income, even if it's R5, you need to declare that to SARS. When you start a business, like you mentioned now, and it's a smaller business that kind of don't have a lot of income, the potential of a loss is so much bigger. Now there's a loss in the business because there's telephone, office space, and internet, and whatever. Entertain clients, go to coffee shops. So now there's a net loss that you can deduct against your salary if you're a salary earner. What is very important with that is, and something that SARS also look at, is this loss, is it actually really a loss, or is it really just a hobby for that specific person? The onus is on you to verify and to motivate the SARS that this is actually a business. I've just started my business. Year 1, year 2, potentially year 3 might be a loss, but I can show you SARS my income is slowly but surely increasing. It's a part-time business. It won't like rocket. It potentially will increase slowly but surely. And my advertising, those kind of things, also my expansion costs also increase, and I can verify that. If you're having a part-time business and your income stays on 5 or 10 or 20,000 rand per year, SARS will definitely scrutinize that, because I mean you clearly don't want to build your business. So you can't year in year out claim a massive loss and think SARS will just be happy. They will scrutinize, and we can go to the ring fencing part of everything right now, because I think that's very important. But typically you see, doesn't matter what the requirements are for ring fencing, SARS don't like a recurring loss every single year. And obviously the motivation becomes difficult as well. And year 1 and 2 is easy because I'm busy expanding my business, I'm busy building it. There is a lot of expenses and not so much turnover yet, but I can clearly show my turnover is increasing every year, and potentially my advertising, all those expenses with that. So I can verify and motivate that business is actually becoming a profitable business. Initially, when I started, I had an assessed loss for the 1 or 2 years. So I was giving me the benefit. I deducted it from my salary. I get the pay as you earn, some of that pay as you earn back. But now I get to the point in, let's say, year 3, where I actually have a net profit. Now I need to start paying SARS, because now I have a net profit that I need to add to my. So there's both sides of the coin. With that, provisional tax start kicking in. So now I need to attend to, how will I start paying this? Will I try to do a monthly payment to SARS to make sure I don't have a massive bill at the end of the year? How do I manage that? But that's obviously a separate conversation. But then it becomes a problem in the sense of that you need to start paying SARS and you don't get the refund. So now the fun is over. In essence, Section 20A becomes applicable on the highest tax earners. So if your taxable income is on the highest marginal rate of tax, on 1.656601. So it's 1,656,601 rand. If you are over that taxable income range, you start showing losses to SARS, then you become in the radar of having a ring fence business. Typically, there's a number of items that SARS look at. So that's the very first requirement. If your income is more than you're in the line of fire, and you can look at potential ring fencing. If you're below that, I want to say you're safe. In theory, you're safe, and you can deduct your losses as you go along for a number of years. But still, I mean, I've seen audits with SARS more and more frequent regarding losses, where they actually want to see why you're showing a loss. These part-time businesses and also rental income is on properties is kind of the two very high audit risk kind of items. So anyway, so you've got the initial step is that split between those two, overall or above. Then you get to what they call a 3 out of 5 ratio that you need to look at. So, and that's obviously again only applicable to over 1.656. So if you show a loss 3 out of 5 years, then SARS will ring fence that loss. And what the ring fencing in essence mean is we put a fence around that specific trade of yours. So we keep that loss. You don't lose that loss. We carry over that loss every year. And the moment you actually start making a profit from that specific trade that we ring fence, you get all these losses and you can deduct it against the profit as soon as you make a profit. So they make sure, because especially in that bracket of income earners, they kind of try to do having a little farm that they do part-time, but only, I mean, it's not really a farm. I mean, they're actually just playing around but they claim a lot of expenses, obviously to get the benefit, and they get 45% of everything they put in as a net loss. They can get a refund. So it becomes a big risk to SARS when people start doing that. You've got the 3 out of 5 years, but you also have suspect trades. So suspect trades, like I mentioned, would be the biggest ones: part-time farming, not full-time farming, properties, and crypto assets and trading. So that's a new one. That was a new one that's on the list now. This is, they call suspect trade. So that automatically let you fall into a ring fence. The third, but you need to have a reasonable prospect of the deriving taxable income and within a reasonable time. So I think that mixed into what I just said about you can't forever a day go on and just show a smaller income, and you can't show to SaaS, but here's my efforts of marketing, here's my efforts of expanding to get to a higher income. See this specific kind of audit in this trend very much in residential property, where obviously in the first few probably 5 years you have a net loss, and then slowly but surely become cash flow positive, and you start showing a net profit. And then SaaS generally has got a page and a half questionnaire about your feasibility and make sure it's market related rental and all those kind of things. The last step is and that's probably the final of a ring fence. And when you finally been ring fenced in that trade for the rest of your life, is if you generate a loss 6 years out of 10 years, you show to SaaS that 6 out of 10 years I can't generate the income, and then they say it's great, you can still do that loss, but eventually in 20 years when you make a profit, you can deduct that loss from that. Again, you don't lose it, but it's ring fenced against that specific trade, but then for the rest of your life.